Okay, and welcome to the very first in the series, which is the Dow Theory. So this series is going to be covering 10 of the most popular historical trading strategies. Number one, of course, being the Dow Theory, which is from the 1800s, a very long time ago, well over 100 years. Now, there are a lot more on there. I've made it a little bit tricky for some of you to work out exactly what they are. If you do know, let us know in the comments down below. It'd be pretty impressive if some of you could actually work that out. But for now, we're just going to start off with the Dow Theory, which was created by this guy right here, Charles Dow, which is, as you probably can guess, the exact same guy that came up with the Dow Jones Industrial Average. So if you've ever wondered why have they been tracking this thing for so long and is it actually still relevant today, you might be shocked to realize just how relevant it actually is. This was really the foundation of modern technical analysis, which was created, as I say, over 100 years ago, and it really laid out the 6 key principles that even today can help traders identify trends and make smarter decisions. So the Dow Jones is an average. It's an average with the industrials being the one that most people use. So it's the 30 top industrials being traded, and also the 30 top utilities and the 30 top transportation businesses. And the idea is that rather than just trying to guess the overall market based on individual volatile stocks, what you want to do is you want to get an average of all the stocks in that class, and then with the individual stocks, make sure that you're going with the general trend. So if the general trend is bullish, then you want to be finding stocks to buy, and if the general trend of the average of that sector is going down, you want to be going down. So after that brief yeah, well, it probably wasn't that good of an explanation. So here we go. This is the 6 principles of market behavior according to Charles Dow, not me. Number 1, the market moves in 3 trends: a primary long-term trend, a secondary medium-term trend, which are corrections in the market, and then the minor short-term fluctuations. So the best way to explain this is going to be to take a look at a proper chart like this. So you can see we've got some very big longer term trends. These are basically like the tide coming in and out at the shore. The tide is coming in or it's going out. Both will have waves. The waves are these that you see here going up and down, some big waves, some smaller waves, but you're going to get waves whether the tide is coming in or going out. And you can trade those. Those are the secondary waves that you can trade, which are going in line with the general trend. So we've got a bullish trend right here, and you want to be buying in line with the trend of the market. And in amongst there as well, you've got all this little intraday trading as well, the tiny little ups and downs in the market, which is known as the noise. And you don't really want to be trading that. And this is where a lot of people slip up early on, is they get into this day trader mentality. They seem to think that, professional traders just trade day trading. They don't. If you're a hedge fund manager or, some sort of big portfolio manager or a pension fund manager, you're not buying in and out of positions on the same day like that, like an idiot. Like no fund manager does that, right? You're going to be going in with the long-term trend and hopefully trading those nice big waves up as well. Now, if you're in a downtrend like this, then obviously you want to be selling off and going with the waves to the downside. And principle number 2 is trends are confirmed across indices. So both the Dow Jones Industrial Average and the Dow Jones Transportation Average must move in the same direction to confirm a trend. Okay, so just down here in this box, we have the Dow Jones Industrial Average in the blue and the Dow Jones Transportation Average in the red. Now, there is also the Dow Jones Utilities Average as well. You can have in there in the purple. Some people like to make sure that All three, or at least two out of the three, are heading in the same direction. But most main traders will just go with the transportation average because transportation does act historically like a leading indicator for the industrials. What we have right now is that both of them are heading upwards. So we got some higher lows over there, same over here. So what we should see on the stocks is going to be the same thing. And obviously this is AMD and Nvidia, which are just going to the moon right now and not showing any signs of slowing down yet. They haven't broken trend. They're still on an uptrend, as is the main average as well. So there's no reason yet to be going short. And then principle number 3, the market discounts everything. Prices already reflect all available news and information from earnings to political events. So basically, there's no point whatsoever in buying the Financial Times every day, reading it through every morning and trying to work out what stocks you should pick based on what the news journalist people are telling you in the newspaper. It's completely worthless. As soon as something happens, the market reacts instantly, particularly today with AI and all the sort of automated trading that goes on. You are not going to have an edge on the market. By the time it's taken you to read that newspaper, everything's already factored in. So number 4, trends persist until a clear reversal. Once a trend is established, it tends to continue until there's definitive evidence that it is reversed. So that's a little bit like what we were showing earlier on that chart, just showing that, you know, we don't have to worry about going short just yet on Nvidia or AMD because the main overall trend of both of the Dow Jones Industrial and transportation averages are still heading upwards. And then number 5 is that volume confirms trends. So an increase in trading volume should support the direction of the trend. So what he's basically saying is if we have a bunch of these volume bars here at the bottom and they're above where they normally should be, showing a good strong volume. You can see here, this one here is much stronger than ones that have gone below before it. Then that should push the price up and continue to push the price off. And then once that volume comes away and obviously goes back to red, then that's probably a sign it's going to weaken off and, you know, that little rally is over. Now, it doesn't always happen just as cleanly as that. I personally, I found a lot of the times that the volume does tend to happen towards the bottoms or the tops. So like this one right here, you can see there's a big spike up in bullish volume here. So nice good green volume candle, but it doesn't really move the market. You know, even when it does come up, which is, it's coming up here on lower and lower volume, which is actually a sign that it is going to fall as well, because you've got less volume, but the price is going higher. Is a strong sign it's going to turn around and come down, which obviously it did. But then here again, so as the price is coming up and that volume is increasing, it's actually around the peak of that little one before it does come back down. But at this point, we have already fallen down below the previous bull run, so we are looking more bearish anyway. So this is where you have to weigh it all up, right? So it does take a little bit of time to get used to all of this. Now, Dow Theory is definitely used by stock traders today. In fact, it's used sort of week 1, day 1 in trading for Goldman Sachs traders and JP Morgan and other such investment banks. They'll be teaching their traders this pretty much day 1, right? It's very, very basic stuff. Number 6 is averages must confirm the reversals. So for a trend reversal to be valid, both indices must confirm the change. Where we are right now, as we showed earlier, you know, it's all looking good and price is continuing to go up and look nice and strong. So that is the Dow Theory in a nutshell. That is the 6 points, the 6 principles of Dow theory. And it could be a little bit much to sort of take in and understand just from one YouTube video, which you'll probably forget all of these principles by this time tomorrow, which is why we've put it for you in a little PDF document, just linked down below in the description. Just click that link, download it so that you can print it out and actually follow it and think about it day by day, and then start to actually get that into your brain, into your mindset when you're looking at charts, so that you can actually make use of this and understand what real institutional traders are looking at when they're looking at charts as well. I hope that this has been insightful to you in some way. Please do give a like, subscribe, and I shall see you again in the next video.